What I want to do is really just take you through how we look at the markets. We at BMO Private Bank are global macro investors. So what that really means is my job is to figure out at any given time how much risk we want to take. Once we've identified how much risk we want to take, then we have to figure out where we want to take the risk. So we put all of the major markets on a level playing field and look for opportunities. And then look for pitfalls and try to adjust the portfolio accordingly. So that's the type of perspective that I offer. I tend to look at the world from 30,000 feet. I look at economic developments, I look at public policy, I look at valuation and so forth. So what I'm going to do is start with kind of more of a history of an evolution of public policy in the U.S., and then kind of conclude there, and then go into some investment strategy. So I'm hopeful to get through this in about 30 minutes or so, and we'll have time for questions after. In terms of where we are now in this debt cycle, you can see here that personal consumption between 1984 and today has grown at an annualized rate of 4%, and yet our incomes have only grown at 3.8%. That's thanks to the help of growth in household debt at around 4.5%. The reason we have this shift to what I would call a debt-based economy is because as we left the 1970s and went into the 1980s, what I would call the post-industrial economy, we ended up in a situation where roughly between 8 and 12 million Americans, most of whom did not have a a college degree, but were earning a middle-class income in what I call a wage job, lost those jobs to many of our trading partners from the developed world. We shifted away from our reliance on manufacturing and into service, and the issue here is service, as you all know, is a knowledge-based economy, and knowledge economy requires some kind of training or education. Well, instead of training or re-educating those 8.5 to 12 million people to meet the new needs of the evolving economy, we realized that training it is expensive, education takes time, so we decided instead of help manage their incomes to prevent an income inequality that would likely widen, we decided to manage consumption. Hope that everyone would be able to live a lifestyle that was more consistent with the help of debt. So essentially, you make your income, you spend your income, you borrow money, you spend that too. And that's really what has been going on since the early 1980s. So if you look at total debt, once we entered the Greenspan era, in 1987, for example, credit cards allowed you to carry a balance. Prior to that, credit cards were convenience cards, meaning that you had to pay off your balance every single month. Once we moved away from that to a revolving credit environment, what you can see here in blue is nominal GDP, and next to it is year-over-year debt growth, total U.S. debt growth. And I think what you'll find, and I think we got hooked on this early on, that we no longer could grow our economy organically. We needed debt to expand in order to grow our economy. And so every time the economy slowed down, right, the economy got the sniffles, what did the Greenspan Fed do? They lowered interest rates, encouraged borrowing, and kept the economy afloat. In fact, there's only 1 year in our nation's history where our total debt load actually declined on a year-over-year basis, and that was between 2008 and 2009, and we know what happened there. So policymakers realized that they can't afford necessarily to have our debts decline for fear that our economy, which again is somewhat levered here, is likely to fall. So if you look at total debt by different components, you can see that between 2008 through today, that household debt has declined, but taking up the slack, so that's the blue line here in the middle, household debt, but taking up the slack is this federal debt that's picked up. Oh, I think I just did turn up the volume on this thing. This is a very high-tech thing. Yeah, I think I'm going to change the colors in there, okay? But remind me not to touch that. But you can see at the top line that we had that one drop, and then even still, even since 2008, our total debt load as a country has continued to climb. So we're not off of the debt treadmill by any stretch. And that would require some kind of austerity, which of course is inevitable to our country. How were we able to grow that much debt? Well, a lot at the federal level, largely with the assistance of the Federal Reserve. Between the end of 2008 and the middle of 2009, the Fed grew its balance sheet from $900 billion to $2 trillion in an effort to provide adequate liquidity in a this kind of leveraged wind down situation. From that point, from 2009 on, the Fed grew its balance sheet from $2 trillion to $3.5 trillion or so, and now it's currently growing at about $85 billion a month. So that's where we currently are situated. Now, before I leave you with the notion that this quantitative easing was just toxic and terrible and everything else, there were some good positive outcomes, positive byproducts of quantitative easing. Most notably are our labor costs. Now, if you look at our unit labor costs in blue compared to labor manufacturing costs in Europe, for example, it's much cheaper and better to do your manufacturing business in the United States. So we've seen auto companies, for example, shift production from Japan here. We've seen chemical companies in Germany move their production here to Indiana. In fact, we've seen Airbus, a French company owned by a consortium of European countries, announce plans to open a plant in Alabama. And I think, finally, most notable, there is a factory in South Carolina that makes chopsticks and sells them to the Chinese. So clearly, because of the weaker dollar and wages that haven't gone very far, plus productivity gains, we have become the destination of choice for manufacturing in the developed world. The other secret ingredient behind our manufacturing is natural gas. So if you look, what we've done here is we've equated natural gas and crude on a BTU equivalent basis. So essentially, as of the end of last week, it costs roughly $93 a barrel for oil, but we can deliver the same energy output using natural gas for about 25 bucks. And so we are starting to see that shift away from diesel into compressed natural gas, into liquid natural gas. But the other advantage here is pretty unique, is that natural gas in North America is trading roughly at a third of the price of natural gas in Europe and about a fifth of the price of natural gas in the Far East. So again, a nice competitive advantage here at home. Also, another byproduct of the Fed stimulus programs is the fact that housing market is recovering. Largely on the fact that jumbo mortgage rates here depicted in blue have moved from nearly 8% to about 4%. And so with a family with a budget for a mortgage, that equates to roughly 40% more buying power. And at the same time, housing prices have dropped by more than 20%, which means that affordability is probably at a generational low, or I should say most attractive. So I do think that the housing market will likely continue at current levels, and move forward. So when it comes to household net worth, we're finally back on a long-term track. What we've done here is we've shown household net worth growth on a logarithmic scale, so we can show it as a longer-term trend line. But you can see that bubble that was created by Greenspan Company through easy credit created this wealth bubble that was perpetuated from the early 80s through 2007. But what I find most comforting here is we're finally back on that long-term growth path. No longer are household wealth figures falling, you're actually back on the long-term trend line. And that's encouraging because between portfolio values and housing values, this new growth path in wealth has created some consumer confidence. And confident consumers tend to spend in retail, tend to shop. And so what we've done here is we've shown consumer confidence depicted here in red against retail sales depicted in blue. You can see, 10 years ago, if you told me what consumer confidence was, I could tell you within half a percentage point what retail sales growth was likely to be. But going forward, we've diverged, and now it looks like we've seen growth in retail, and that's slowing and improving confidence to some degree. And I think that's a theme. What we're seeing in the economy now is growth, but growth slowing at an incrementally slower rate. And that's a concern because that's called into question this quantitative easing program. Is it really working? And I think that's upsetting the markets today. So you can see purchasing managers, production, new orders, all below 50, which means now we're in contraction for the first month in a long time. Employment just on the bubble itself. Moving over to the labor markets, this is really the drawdown in labor. What we've done here is we've just shown starting point to a drawdown in percentage over the number of months. So we've compared all of the labor market drawdowns in previous downturns back to World War II. And you can see, obviously, the current one we're going through is the deepest and most protracted downturn that we've endured. In fact, we still haven't recovered all of the jobs that we've lost, and we're 65 months into this recovery. Looking more closely at the jobs market, as I said, we never trained our workforce. We don't have a workforce that's equipped to meet the needs of the private sector, and so now we have this mismatch. Okay, we had this consumption equality experiment. It's played out. We can't perpetuate it anymore. So now we have to go back to basics, and you can see here we've now got two labor markets. Really one labor market. One where you have a college diploma, and one where you don't. And you can see very, very different. In a knowledge-based society, unskilled work is pretty much disappearing. And so what we're finding now is that the college degree is now that ticket to the middle class. And unfortunately, attaining a college diploma has become very, very difficult. And a lot of it really predicated on what zip code you're born in, unfortunately. And you can see tuition prices for as high as medical costs have risen, college tuition costs have gone up even more, leaving household income in the dust, making it less and less attainable. And this is a concern. This is a vital concern in a world where we need to continue to train our workforce, and the value of the work that we're creating in our private sector continues to move higher and higher. So what we're finding is, and probably shouldn't surprise, is that 40% of employees surveyed said they're having a hard time finding qualified workers, and yet we have an unemployment rate of 7.8%. That suggests to me we have a mismatch between what our private sector employers are looking for, skill-wise, and what our workforce is equipped to do. And this is a concern. And again, college right now, about 28 to 30% of kids aged 24 to 35 have a college diploma. That's about the same rate as Egypt. So when you compare, I have a math degree, so I look at standardized math scores. And here's my concern is that our math skills are not up to the same level as our trading partners. So, for example, the PISA, which is an international standardized test, is similar to the SAT. For those of you who are familiar with it, you get 200 points for putting your name on the page correctly, and 800 points for getting all the answers right. Here in the U.S., we're scoring an average of 480. And you can see in Shanghai, these kids are scoring 600. So eventually, as the service economy becomes globalized, could you envision an environment where these kids in Shanghai are competing for the same jobs as the kids in the United States. Okay, and it is likely that at least if it requires some kind of a quantitative skill, that these kids in Shanghai are more likely to get those jobs than the kids in the United States. That's problem number one. But the main problem is this, that our per capita GDP in this country is $38,000 a year per person. Per capita GDP in Shanghai is, well, in China is 2,800, but if you make adjustments for Shanghai and you make adjustments for the currency, it's probably about $10,000 a year. And we're scoring 480 on our PISA, and they're scoring 600. Could you imagine a world where that slowly over time, that green line and that yellow line converge as the kids in Shanghai are doing the same jobs as the kids in the United States? Anyone? 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 Okay, I agree they will. And so policymakers have to realize that if these lines can cross, right, if these lines cross at $30,000, what happens to our debt? We're going to default. We can't afford to have these lines cross at a number that's lower than $38,000. So policymakers reckon this is a huge deflationary factor, one that's going to keep prices low, it's going to keep interest rates down. Inflation's not an issue, and it's one that the Federal Reserve and other policymakers understand that they're fighting. So there are two ways to battle this. One is through education, the other is through inflation. And I think it's a two-tier approach that policymakers will likely tackle. Now, the good news on the education side is we're starting to make huge progress in innovations in education. Has anyone here heard of a MOOC? Okay, one person. Two, three, okay. MOOCs are massively open online courses. These are online classes offered by some of the most prestigious universities in the country, and most of them are available for free. So now slowly, we're starting to get what I'll call the democratization of information. Slowly, anyone in this room who wants to take a college class offered by virtually any university can go online and take the class and audit the class, so to speak, for nothing. In fact, starting this year, there are universities, most notably the one I know is University of Wisconsin, is offering a program for about $10,000 you can get. They are offering 2 bachelor's degree programs and 2 designations where all you have to do is pass a comprehensive test. It's like the CFA or some other CPA type program. And attaining that information is up to you. You can learn it from them, you can learn it from some other university, or you can go online and learn it. But if you pass the comprehensive test, you get the designation. So now slowly, we're going to get to an environment where I think the price of a bachelor's degree is going to come down to under $10,000 a year. And I tend to use kind of bachelor's degree sort of as a pejorative, but it's really training. Okay, it's really specific job training, whether it's software, medical, whatever, can be done in these programs. And so instead of getting the MBA, you get maybe a CFA or you get some other designation that has a specific skill set and a body of knowledge around it. And these are designations that employers will recognize. Anyway, so good news on that front. The inflation side, I think that's, policymakers are trying to beat that inflation beehive with a stick and hope that the bees eventually come out. We haven't seen that yet. So turning our attention to investment strategy, we look at 5 factors when we evaluate the market: valuation, the economy, liquidity, psychology, and momentum. Here, valuation is stretched. We think that the stock market broke away from fundamental fair value back at the end of February and has moved most notably on liquidity and momentum. The economic backdrop is neutral but slowing. And psychology, neither bullish nor bearish, fearful or greedy, and we're leaving that one off. On the valuation front, we look at the price to sales, starting price to sales ratio, and the subsequent 3-year return, cumulative return in the market. Here, at 1.5 times, would suggest an annualized return of 5.4% per year for the next 3 years. But one of the concerns I have is that this is our price to sales ratio, you can see there are a lot of dots in this range that are below zero. So this is not a cheap market we're in. I'd love to be back over in the 1.4, 1.3 area where we can have more of the positive intersection up there. But that's one concern. The good news, though, on the liquidity front is that for the first time consistently in our history, that the free cash flow yield on S&P 500 on equities is actually higher than the average yield on high yield bonds. Essentially, you could take, if you could issue high yield bonds and buy the entire S&P 500, you'd be able to leverage the whole thing up and buy it back and have a positive carry on this. So there is a huge motivation for buybacks. We've seen the Dell deal, the Apple deal, the Heinz deal, some of these others predicated on this huge variation, this huge spread between expensive bonds and relatively cheap stock. So I'll give you an example in this Dell deal. Okay, back in December, 10-year single-A Dell bond was 2.4% yield. Free cash flow yield on Dell stock is over 17% at that time. So even if you issued enough bonds to turn into junk, and you had to go issue at 6 or 7, you still had 1,000 basis points of cushion to be able to pay back that debt. And from my perspective, I believe that Dell Computer is the blockbuster video of the computer world. Doesn't matter. 1,000 basis points is a lot of spread, even if the company's only around for 5, 6, 10 years. You can see the sectors with the highest free cash flow yield: finance, telecom, tech, and healthcare. All right, everyone's worried about tapering, and this was just a study we did yesterday. The markets, yields have gone up in the market, at least in the previous month, by about 50 basis points. Everyone's worried that the Fed is going to remove the stimulus, and that's going to cause a downturn in risk assets. And what I'm showing here is, on a weekly basis, over the last 50 weeks, there were 11 weeks where the 10-year Treasury rate was up by more than 10 basis points. And the average return on each of these asset classes was positive. So I'm not as worried about positive movement in interest rates. What I am worried about is negative drops in interest rates like we had today. Okay, so if you look at over the last 50 weeks, there were 7 weeks where interest rates declined by more than 10%, 10 basis points for the 10-year Treasury. You can see the average return on risk assets was negative. And the reason for this, I believe, has more to do with it has a lot to do with the Fed. That I'm less worried about the possibility of Fed taking their stimulus off in a rising rate in a growth environment than I am about having the Fed painted into a corner if the economy starts to decline, and rates drop. And that's exactly what's going on today. So if you look at the kinds of sectors that underperformed in the market today, these were cyclical sectors. These weren't taper type sectors, right? If people were worried about tapering, then the worst performing sectors would be utilities, staples, telecom, the defensives. These are the bond proxies. The sectors that underperformed today were the basic materials, the technology, the industrials, the cyclicals. And they're worried that the economy is slowing and the Fed can't do anything about it. And then lastly, I just want to throw this up there just because of the numbers look pretty interesting. If you take the year and divide it into 2 6-month periods, May through October and November through April, and split it, you can see we've had very different outcomes. In fact, we went back to 1900, started with $1,000, invested in these two portfolios. And we found that between 1900 and 1958, the values of these portfolios moved in tandem. In fact, by 1958, $1,000 in both sides of this trade grew to about $3,500. And then in 1958, all of a sudden these portfolios diverged. In fact, the May through October portfolio declined from $3,500 to $2,100, and the November through April portfolio expanded to 122,000. Now this doesn't include dividends, it's just Dow price only. But the point here is that I can essentially explain the entire return of the stock market over the last 55 years in the months November through April. So why aren't we out of the market and just sitting on the sidelines? Because we can't explain it. I can't find fundamentally why this is happening, so I can say, is this condition in place this year? But I will say this has been a pretty persistent trend, and it has worked over the last few years. So with that, let me stop there and see if there are any questions. Yes.
What does the student loan debt combined with the credit card debt? What are those two big debt amounts do to the economy going forward? I mean, are they going to have a huge drag on the economy for the next 2 decades?
Yeah, student loan debt and credit card debt. Yeah, I mean, it's household debt altogether could be a drag, because here's what happened. You know, as I mentioned, as I showed you in that first slide, that income growth was 4%. I'm sorry, that spending growth was 4%. Essentially, our growth in our economy was 4% over roughly a 40-year period. Okay, but the problem is the potential growth rate of our economy is something like 3%, right? We get about half to 1% for labor force growth and another 2% for productivity, means that potential was 3. So my point is that we grew at 4 in an environment where we should have grown at 3. Why? Because we took our incomes and then we borrowed money and we spent that too. So now I argue that, okay, well, what's our potential growth rate? Our potential growth rate is now half. Our labor force is growing at 0.5%. And let's assume productivity continues to expand at 2. So now we're at 2.5% potential growth rate. And we have to now take some of our income to pay down that debt you're talking about, which means that what kind of a growth can we expect? 1.5 to 2. I mean, that's it. You know, and you've got Federal Reserves, you know, central banks all over the world trying to take this, you know, 2% donkey and try to beat it into a 4% horse. It's physically impossible, because the lending isn't going to, you know, you're going to have to keep borrowing to make that happen. So we do need to now grow below potential, which means that we're going to grow in the 1s and 2s, and that's not fast enough. You know, without this education and retraining, you know, unless we can get market share like we're trying from other parts of the world, you know, I don't see how we're going to be able to create these jobs, you know, unless we really rethink our education. You had a question.
Yeah, I agree with you that the China education gap is alarming, and we need to up our game there. But going back to your graph about GDP per capita, another way of looking at that equation is income per capita. And in that case, USA is roughly 50 grand per capita, and China has a per capita income over just about Jamaica.
Right.
So, I mean, what's that telling us?
So what that's saying is so it would be like they're saying, well, they're requiring a lot less. So even if their math scores were the same as ours, they would then employers would want to hire them because they're earning less than we do.
But they're inflating very quickly.
Well, that's what we hope. That's what we want. Yes.
We may not have this, but there might be a more characteristic way of referring to Chinese education or Asian education than just Shanghai and Singapore. I mean, that would be like saying, Palo Alto, New York City.
Right.
So there's another 800 million people there who barely literally don't. We really shouldn't knock ourselves on the head over that. You know, the other ones were all whole countries.
Right.
So those are more relevant.
No, I mean, it's true, but I mean, Shanghai as a city is the size of a country by itself. I mean, I was just there. It's like, I would say the way I would describe Shanghai would be like a combination of like 2 New Yorks with a Las Vegas veneer over it. It's crazy. It's fun. It's crazy. But yeah, I mean, I agree, but again, the competition is you know, it will definitely come from there.
The other thing is that are sending their manufacturing over here, you always see the big places like Alabama or Georgia. Are they really seeking educated people there? Are they seeking minimal high school type education with a strong propensity for work?
Yeah, I think what they're seeking is right to work states. Okay, so I think ideally they'd love to go to Illinois and they'd love to go to Michigan, but they don't want to pay union members. So what's happening now? Indiana just went to right to work. Wisconsin's going to right to work. Michigan just went to right to work. So we're here left out in the lurch, right? We're still a single party state. We're like China. There's just Democrats instead of communists.
What is your outlook for the dollar for the next 5 years?
Sure. My outlook for the dollar, I don't have an outlook for 5 years, but I will say my outlook for the dollar for the next 12 to 18 months is positive. I do expect the dollar to gain ground. Some of the trades, I still think, some couple of trades we have on are we're short the Australian dollar. I think that's a trade that should continue to work. In fact, it's a defensive trade, and I think it worked today. We also are going to start to invest in Europe and hedge that euro back to the U.S. dollar. We think that there will be enough pressure on the ECB to start trying to stimulate the economy, take some measures to do that. They saw U.S. do it, they saw Japan do it, and now if you're trying to sell a Mercedes against a Cadillac and a Lexus, your competition just took 20 to 30% price cuts, and you're stuck. So I think there's going to be a lot of pressure on Europe to try to reduce the value of the euro, or at least stimulate their economy. We're already starting to see steps taken to do that. They're not quite as strict on budget. They're extending loan repayments. So they're letting this austerity program slip a little bit. I expect that the ECB meets tomorrow. I think we may, I'm hopeful we'll get a positive surprise because we're already betting on something from Europe. Yes.
Yeah, about the euro, you do not see any scenario where the euro will break up?
Where it would break up? I think there are scenarios where it would break up, but it really would. I would say policymakers in Germany would have to just be so stubborn and not relent at all, where these these weaker countries would then just relent to their to the protests. But it hasn't happened. You would think of all places it would happen in Greece, and I could argue that I think Greece would benefit in the longer term with you go back to the drachma, but they're staying with it. So perhaps ECB policymakers and German policymakers will help ease that burden some.
Yes. I got a question on your education numbers. How does that apply to postgraduate degrees? Is it worthwhile to spend the money for additional degrees beyond a bachelor degree?
Yeah, I think from what I remember from my numbers, I think if you look at the top 1%, 85% of the top 1% in this country have a graduate degree or higher. 15% don't. So among that 15%, would have to be Mark Zuckerberg, Bill Gates, Steve Jobs, and anyone that can throw a 90-mile-an-hour fastball. Anyway, all right, great. Well, thank you very much for taking the time, and I'll be around if you have any other questions. Great. Oh, one more?
I thought somebody would say gold.
Oh, gold?
And now, since you're looking for a strong dollar going out, what impact is that going to be for buyers of gold, particularly outside of the U.S.?
Sure. Yeah, you're right. A stronger dollar
would hurt the value of gold. We think that gold, if you look at gold's relative return to other commodities, it tends to predict inflation 2 years out. And based on its current position, it's projecting a 13% inflation rate in 24 months. And so we think that it's too far. I mean, it'll have to underperform other commodities to try to get back in the line if that relationship is, continues to hold at that level. But it's been in place for a while. And so, like I said, we're not huge fans of commodities, and we're not huge fans of gold right now. Anyway, great. Well, thank you very much. All right.